Illustration 1 from page number 529 of financial accounting, AS1 related illustration this is. So this illustration says Jeevandeep Limited had made a right issue in 2010. In the offer document to its member, it has projected a surplus of Rs 40 crores during the accounting year to be ended on 31st March 2012. The draft results for the year prepared on the hitherto followed accounting policies and presented for perusal of the Board of Directors showed a deficit of 10 crores. The board, in consultation with the managing director, decided on the following. So, the Jeevandeep Limited we are speaking about of their financial statement, they made a right issue in 2010. In the offer document to its members, it had projected a surplus of 40 crores during the accounting year to be ended on 31st March 2012. The draft results for the year prepared on this accounting policies and presented showed a deficit less than 10 crores. Now, there is a question. It was said 40 crores and now there is a deficit of 10 crores. Why it is? So they are analyzing what are the reasons it would have been and what is the end. As the chief accountant of the company, you are asked by the managing director to draft the notes on accounts for the inclusion in the annual report of 11-12. So why is the deficit been there? This they have spotted, and these are the 4 reasons. And these 4 reasons, if it is falling as a change in accounting policy and all, then it should be part of notes to accounts. So we have to read this all the 4 reasons and find out is a change in accounting policy and how it has impacted our profit, and accordingly we should make a disclosure of it in our notes to accounts of Jeevandeep Limited. Okay, so the solution will be, first we have to quote from AS1 what has made you to make this decision of making this as a part of notes to accounts. So you should say, in a case of changing accounting policy which has material effect in the current period should be disclosed. So which has material impact on, yes, that has reduced its profits. So it has material impact. It is in crores. If it is in crores and all, yes, it is a material impact. The amount by which an item in the financial statement is affected by such change should be disclosed to the extent ascertainable. Where such amount is not ascertainable wholly or in part, the fact should be indicated. If you know the figures, how much it has impacted, then give that figures. If you can't find the figures, how much amount has been impacted, then just give the disclosure of it, that this has been impacted and there has been impact on the profits of this current period. Figures may not be ascertainable, but it has an impact on our profits. That disclosure should be given. And these disclosures will be always part to the notes of accounts. So how? We will read the first. Value year end inventory at works cost 50 crores instead of hitherto method of valuation of inventory at prime cost 30 crores. So what has happened? Earlier they were valuing inventory at prime cost at 30 crores. And now they have changed it to works cost. First they were valuing at prime cost, now they are valuing at work cost. At work cost they are valuing, so the value of inventory has become 50 crores. So what happened? Our assets have increased, our income side has increased. By how much? First it was 30, now it became 50. So suddenly the revenue, our profits are inflated by 20 crores. So we should give a disclosure that as there hasn't been change in accounting policy, instead of valuing it at prime cost, we have changed it to work cost. Our profits have been impacted by the difference amount, which is 20 crores. So you can see, till last year it was a practice of valuing inventory at prime cost, but during the year the same was valued at work cost. Due to this change, the closing inventory was valued at 50 crores and accordingly profit was increased by 20 crores due to the change of the method of valuation. Second, provide depreciation for the year on straight line basis or account of substantial additions in gross block during the year instead of the reducing balance method which has been hitherto adopted. As a consequence, the charge of depreciation of at 27 crores is lower than the amount of 45 crores which has been provided had the old method been followed. That is 18 crores difference. Can you see 27 plus 18? Okay, it's 45. So, what you will write? During the year, the company has decided to change the method of providing depreciation from reducing balance to straight line. So, here further they are about to take straight line. Earlier they were doing reducing balance method. So, if they had been following reducing balance method, they would have depreciated at 2045, right? As a consequence, the charge of is lower than the amount of 45 crores. So, it has been the depreciation we were charging on reducing balance, it would have been 45 crores. But as we have changed it to straight line, our depreciation has been only 27 crores now. So, what has happened? We have charged less depreciation. So, profits got inflated. What is the difference? 18 crores. So, we are saying as change in depreciation has made that amount of depreciation, amount of expenses we are showing is become less. And because of that, our profits have been inflated by 18 crores, increased by 18 crores. Next. Not to provide for after sales expenses during the warranty period. Till the last year, provision at 2% on sales used to be made under the concept of matching of cost against revenue, and actual expenses used to be charged against the provision. The board now decided to account for expenses as and when actually incurred. Sales during the year total to 600 crores. So, what has happened? They have earlier they were making provisions. Now they are not in the plans to provide it. So provisions we are showing means we were showing expenses, and now here further they are not planning provisions. So we are not showing that expense. So our profits will get increased. How much? 2% of sales provision they were making. What is the sales figure? 600 crores. 2% of 600. So can I say 2% of 600? So it is 12 crores. So 12 crores expenses we are not showing because they have changed the policy. So net 12 crores has impacted our profit, and our profit has increased by that. So accordingly we should make the disclosure of the same in our notes to accounts. Provide for permanent fall in value of investment which fall had taken place over the past 5 years. The provision means 10 crores. So what has happened? There has been investments on which value of the company had made investments on which there has been fall in the value of it over the past 5 years, or for which the provision is required to be made, which is to the extent of 10 crores. So if you are making a provision, it's like showing an expenses. So what? We are showing extra expenses which has never been there. So our profit is getting reduced. So profit would be reduced by 10 crores. So these are the change in accounting policies. So disclosure is required, and this change in accounting policies has how impacted our profit. That disclosure with the figures and amount should be given in your notes to accounts. If the figures are not ascertainable, then the disclosure should be given with a specification that amounts are not ascertainable, but disclosure is mandatory. Fine.